Hello friends, welcome to today's class. We're going to talk about CAIIB risk management. Risk management is an elective paper, one of the electives in case of CAIIB, plus it is a part of your BFM module. It's also a part of the BFM module part B. Module B talks about risk management. Now, in elective paper, we have the following modules. Today, we're going to only touch upon module A, which is on the overview of risk. And this is an introductory session. So we're going to discuss two very, very simple and easy topics, which is what is risk and what is the concept of risk, zero risk. But friends, in this session also, one or two questions are expected in your CAIIB exam, right? So though it's a very simple and little theoretical concept, yet it's very important to understand what exactly is risk and what's the concept of zero risk. So without wasting much time, let's begin with this session. So let's start with what exactly is risk. Now, risk is any harm or hazard. The first thing that comes to our mind when we talk about risk is some harm or some hazard. For example, I'm driving, I plan to go out on a car drive and I meet with an accident. This is a risk. I want to, let's say, start up a new business and my product or business fails. That's my risk. I want to reach for an interview in, let's say, Mumbai, and I'm going to travel by flight and my flight gets cancelled or delayed. That's a risk. Any harm or any hazard that happens, which is not favorable to us, which is going to be not beneficial to us, is what is risk. And daily, day in and day out, in every walk of life, there's risk. What if? What if this happens? What if? And when we talk about what if, we're already talking about something which is going to be harmful to us. So that is what is risk. There is an uncertainty and a possibility. It's not certain. We are not sure. It may happen or it may not happen. So we are not sure of its happening, right? We don't know. We are not sure that if we take the car out, we are going to meet with an accident. No, we might just reach our destination safely. We might go and the flights may not be delayed. We may reach interview on time, but there's always this possibility of that adverse happening. Possibility of adverse outcome or a loss or a reduction in profits. And when we say adverse, we are talking about something negative, a negative connotation, something which is unfavorable, right? When we talk about risk, we always talk about something happening in future. What if? If that future is what is risky, because that is what is uncertain, that is what is unknown. And therefore, there is always an element of risk. If it was the past, if it's the present, we know about it. It is known to us. There is no risk in there, right? A farmer sows a crop, right? Hoping that there will be good monsoons. And the monsoons don't happen on time, or they are less than what is anticipated. In that case, he suffers a loss. Now, this is something, when he sowed the crop, he thought that in the future, the rains might be normal, but the rains were not normal. They were less than the normal. And because of which he suffered a loss. Now, this is something of a future happening. And this is what is the risk. Some uncertainty about a future event, which may cause us some loss. There's always a variance in the actual and the expected return. So the farmer thought that the rainfall would be normal. This was what he expected, right? And actually, it was less than normal. It was less than normal. This was what was happened. This was actually happened, right? So there is what? A variance. Variance means there is a difference here. Because there is a variance and it is adverse, it is less than what we expected. This is what is risk. Now, for example, we're giving CAIIB exam and you think that you're going to pass with, let's say, 70% marks. Now, what could be the possible scenarios? The first scenario could be you pass with a 70% marks. This was what your expectation was. Yes, friends? your expectation was met. So there was no variance here, right? So we can say, we can assume that there was no risk. We thought and we got. So actually, there's no variance. The other one is, let's say we pass, but with a 60% marks. Now here, is there a variance? Yes, there is a variance. Is the variance positive or negative? We thought we were going to get 70%. We got 60%. It is a negative variance. So there is this risk that we may not get. Now, let us say, for example, we don't get a 70% plus, would it be in a distinction? We don't get a distinction. So this is a risk. Let us say we pass with an 80% marks. Now, is there a variance here? Yes, there is a variance. Is it positive or negative variance? It's positive. It is better than we thought. We thought we were only going to get 70%. However, how much did we get? We got 80%. We got better. So this will not be termed as risk. No risk here, right? On the other hand, if I fail, instead of passing, there is again a variance and that is also negative, then we term it as risk. So when we talk about risk, we're talking about a variance. Next, we're talking about a volatility in income. Let's say I am in a government job and I'm getting 10,000 rupees of income or salary every month, right? Now this is fixed. Fixed means whether I do well or I don't do well, whether I perform or not perform, I'm assured that I'm going to get an income of 10,000 rupees, right? So there is no variability in my income. There is no volatility. It is steady income. It remains the same month on month, right? So that is what we call it as no risk. However, instead of this, if we were into a business, let's say we were having a business. Let's say there's a businessman who is a hotel owner. And let's say the hotel is somewhere in, let us say, Nainital. Now, for example, let us say the hotel is in Nainital and few months, let's say the April to June months went very well and he earns a 1 lakh rupee income. On the other hand, let us say from August to October, there were heavy rains and there was a lot of rainfall, landslides. The income was only rupees 20,000. Now, what has happened? There is a high variability in income and therefore there is a high risk. So for somewhere where he's a businessman, the variability in income is very high. So that is what, there is a lot of risk involved. But where we were a government employee and there was a fixed income, there was no variability in income, it was fixed day in and day out. In that case, we would say that there is no risk, right? So risk is when there's an uncertainty that the expected income will not happen. When any such uncertain events happen that could result in a loss, it is called risk. I hope this is clear, friends. So if we have to look at the definition of risk, and this is where, you can be asked questions. Risk is a chance of loss. It is a possibility. It's a chance of loss, a possibility of some adverse occurrence in future, because future is uncertain. Uncertainties resulting in adverse outcomes, adverse in relation to what? To what we had planned. So if it was, let us say, better than what happened, I planned for, let us say, only a 70% marks and I get an 80%. This is no risk. When it is something less than what I had planned, when it is an adverse in relation to my planned objectives, my planned expectations, then that is what is risk. For example, I have a business that I start up. Now, the first year, I expect that I'm going to get a loss. It's the first year of business. I said, okay, I'm going to get a loss of 50,000 rupees. I'm going to make a loss. This is my planned objective. This is what I planned expectation. Actual loss was much more. I suffered a loss of 1 lakh rupees. This is my risk. But if my actual loss was 25,000 only, then I would say this was not risk, because I'd already thought that I'm going to be having a loss of 50,000, right? So this is what is risk. Another important concept here, friends, is your financial and non-financial risk. So we're going to talk about financial risk here. There are uncertainties resulting in adverse variations in profitability or outright losses. So any loss that is happening that's impacting your bottom line, anything that's impacting your profits, is your financial loss. right? And that happens usually because you have variability in your net cash flows. Cash flows matlab, what is your inflow, what is coming in, minus what is your outflow, what is going out. So what are your revenues minus what are your expenses? This can either be profit if it's positive, revenues are more than your expenses, or it can be your loss if your expenses are more than your revenues. Any variability, any changes in your cash flows, if they are not fixed, it can lead to risk. Because we explained what is financial risk, friends, we're going to understand what is NFR or non-financial risk also. Non-financial risks are not directly leading to impacting your having any financial law impact or directly impacting your profit. For example, your reputational risk, or for example, your legal risk. For example, let us say you have a property dispute with one of your business partners. Now, this is not a non-financial risk, right? There could be some legal litigation that you have with your vendor, right? For some supplies that he has made to you. Now, this is not a, it's not a financial risk. We say it's a non-financial risk. Similarly, let us say there is some corporate governance issue, or there's some strike in your labor strike is there, because of which it has hurt your reputation as an employer. Now, these are non-financial risks. Yet, friends, it's not that these non-financial risks will not impact your financials. Most of these non-financial risks, if not managed, if not curbed, will impact your financials also. So we need to be very, very careful about these non-financial risks also, right? So this is what is your non-financial risk. Now, moving on, let's now understand with an example how this variability in risk looks like. So let's say, for example, we have a sugar manufacturing unit, or we can also take it as any trader, any manufacturing unit. So we have on one side the inflows, on the other side we have the outflows. So we have inflows here, we have the outflows here. When we talk about inflows, we're talking about the revenues. When we talk about the outflows, we're talking about the expenses. The difference between your inflows and the outflows is your profit or your loss. Now, if you see here, neither the inflows are stable or fixed or steady, nor the outflows are fixed or steady, right? So both are variable, and because of which our profit or loss varies. So because let's say he's a businessman, and when we talk about revenues, we talk about the selling price per unit. One mango, what is the selling price of one mango into the volume? That is the number of mangoes sold, or the number of sugarcane bags sold. Here I've taken the example of sugar. So we're talking about sugar bag per unit into the number of sugarcane bags sold, right? So if you see the volume was 1000, 1100, 800, this is variable, this keeps changing. The selling price of sugar also changes, and therefore the revenues in year 1 or 2018 was 50,000, increased to 66,000, and then declined to 40,000 again. The cost, which is usually the raw material cost, the selling or the advertising cost, the administrative cost, some kind of registration cost, all of that included. Now this is the 30 plus 7, 37 plus 3, 40 multiplied by the number of units or the volume sold, we get all our expenses here. The difference between the two is your profit or your loss. So for a business, the cash inflows and the outflows are very, very much variable. They are not stable. And if the movement in prices is favorable, let's say the best year, if I would say, in amongst these three is 2019, where the number of units sold was 1100 and the selling price increased to 60, right? So I earned a revenue of 66,000. My expenses were still low and I got the maximum profit. So it can lead to very high profits also, or it can lead to loss when my price movement or other factors are not in my favor, right? So wherever there is high variability in your net cash flows, higher is the risk, higher the profits or the losses, right? Lower the variability in your net cash flows, Lower is the risk, lower is the profit or losses. So high risk means high upside or high downside potential. There will always be this risk that it may lead to very high profits, or you may suffer huge losses. I hope this is clear, friends. Now moving on to, therefore, just a summation or a summary of all that we've studied. The risk is basically on account of any kind of uncertainty, and uncertainty is a pointer to a risk. It's not the risk itself. Risk exists everywhere, day in and day out, every single day, whatever we do, there's always an element of risk. It is something that is all pervasive. It is something that exists everywhere. We cannot eliminate risk. We cannot eliminate risk. We can only manage risk to a certain extent, right? Risk is certain. It is bound to happen. We don't know when, the timing, and its impact. These are the two aspects which are uncertain. Risk stems from this uncertainty or unpredictability of future, because future is what is unknown. If you don't know about the future, volatility in the potential or the expected income. If it was stable, like in a government job, we knew it was fixed income, like a FD, fixed deposit, we know that we're going to get a fixed return every year. If it was fixed, there was no variability, there's no risk. It's a safe investment. It's a safe job. A risky proposition is one with a potential profit or a looming loss. So there is a chance that you can earn very good profits. At the same time, you can suffer huge loss if things don't work out in your favor. You set up a new business. The business may go very well, or the product may not be accepted in the market. So there may be a huge loss. Low risk implies low variability in cash flows and low upside or downside potential, like we saw in case of FD, for example. FD is a safe investment, low risk investment. So your cash flows are fixed. There's less variability. But then in that case, our ability to make profits is also low. High risk implies high variability in cash flows and high upside or downside potential. Risk is inseparable from return. We always see this. If there is a positive, and see, when we talk about risk and return, it is not an inverse relationship. It is a similar relationship, right? So we have high risk, high return, low risk, low return. It is not inverse. It's not opposite to each other. It is the same, moving in the same direction. Every investment involves some degree of risk, which is considered close to zero in case of a treasury bill, or very high in case of let's say equities or a real estate, right? So every investment will have risk, but the safer ones are your fixed deposits, your T-bills or treasury bills, where there is less variability. There's a fixed return. Risk involves a choice. Wherever there is a choice, when you have to take a decision, when you have to take a choice, you have various investment avenues, and you have an option to go with this or to go with this, to go with an FD or to go with an equity. Because the risk involves a choice, there is a risk which is attached to the decision that you take. It can be high risk, it can be low risk. And there is an uncertainty attached to it. So basically, two characteristics of risk are uncertainty and loss. So if I need to define what is risk, risk is nothing but it is a chance or a possibility of any adverse occurrence which is in future and adverse in relation to your planned objectives or expectations. Right, friends? Now, there's one aspect that we need to study, which is the concept of your zero risk or risk-free investment. I hope till now everything is clear. Now, zero and risk-free investment on a very, very basic way. If I just see what was a risky investment, right? Opposite of that is what is a risk-free investment. Where's those no risk? Now, when there is no risk, there will be no variability in my cash flows, like a government job, right? Every month I'm going to get a fixed income. When I invest in a government bond, when I invest in a fixed deposit, let's say I make an FD of 6% of rupees 1,000 for 3 years. Now the investment is assured every year he's going to get 60, 60, 60. Plus third year is going to get his principal back. Now, this is something which is going to remain the same. It's not going to change. So the cash flows here are certain and fixed. There is no uncertainty attached with the cash flows, right? So low or zero risk means simply also means low returns. We said that it is not an inverse relationship, which means they move in the same direction. So if you have low risk, the returns will also be low. Low risk, then low returns, right? For example, FD. How much do you get in an FD? Let's say 6%. If you take on and invest the same amount of money in equity, you can get a 10 to 12%. If you invest the same amount in a mutual fund, let's say balance mutual, you get a 7 to 8% return. Higher the risk, you're getting a higher return. Why? Because you need to get compensated for the risk that you are entailing. For that risk that you are undertaking, you're going to be compensated through a higher return, right? Now, practically speaking, there is no concept of the zero risk. There's always the inflation angle which comes into play. I invest in an FD today. Okay? Year 1, year 2, year 3. Now, I just said 6% is what my return. So it is fixed. Where is the risk? This is zero risk investment. But there is an inflation element which will keep changing. Let's say this was 3%. It increased to 5% and then came down to 4%. Now, what will be my real return here? Here, my real return will be 6 minus 3, 3%. But the next year, because inflation increased to 5%, this has remained the same. My return on FD is still fixed at 6%. My real return comes down to only 1%. And year 3, it comes down to 2%. So even if the FD was giving me a 6% interest year on year, which was fixed, and I thought everything is now sorted, yet because there's an uncertainty element in the inflation, the real returns were actually much less. So if you are even investing as for your retirement, which is some years in future, whenever you invest, you factor in what would be the impact of inflation, because you need to see that actually your funds will be adequate to meet the inflationary or the cost of purchasing power then. So few years from now, will we be able to meet our expenses? Will 100 rupee now be enough 10 years later? Or will actual value of this 100 rupees will only be 20 rupees? So that is what we're going to see. Right? So I hope, friends, today's topic on what is risk and what is zero risk is clear to you. So thank you so much, everyone, for today's session. And I hope you enjoyed it. So thank you so much. And we will be coming up with more such sessions soon. Thank you.